things first, and the number of for sale has gradually been drifting down from September 2015, and we're now at 14,153. We usually reach equilibrium at around 12,000 between supply and demand, so we're still above that in a buyer's market at 14,000, and you can see that gradual slope where in different parts and different seasons. In July, winter's traditionally a period where we have a bit more stock on the market, and spring will also have a lot of stock come on the market, and then it tightens up towards December, and then we see more stock come on again. But the number for sale has staying below this downward trend, and that's good. We don't want it to ever peak up above, because that would mean that we're not continuing to improve, and something's going wrong in our recovery. And what I'm actually going to expect to see as our market continues to improve, can you imagine how many people have wanted to sell over the last 2 to 3 years? There's a lot of them pent up, waiting to sell if they can get the price that they need. So we'll see this supply actually starting to increase a bit as the market comes back, and that's going to actually delay our recovery. It's going to take a long time, possibly a couple of years for all those people that have wanted to sell to wash through and exit and get their price as things start to recover. So what we need to see is the demand side of numbers sold starting to break out of this sideways, if not slightly downtrend, and it hasn't really changed much yet. And this has actually been one of the lowest sale winters since I've been keeping data for 5 years. So until we see the sentiment change, the jobs side change to really spark that migration coming back to our state, until we see that significant change, we'll gradually keep coming back in our recovery, but it's not going to really kick up to a recovering seller's market until we see the demand, change. And it's really, there's no major area to be excited about on that front yet. I'll go into some of the economic indicators for the state that have just been released, and they're released every 6 months, and that will have a big flow-on effect to the demand. When we look at the median house price, you can see that all that time, obviously, we've been gradually dipping down. We're at 515,000 now. It's crazy when we look across the eastern states, isn't it, now, when we see where Sydney's at, having doubled in the last 4 years, Melbourne, significantly higher than us. So a lot of eastern states investors have definitely seen the value in Perth as a capital city relative to the other states, and it also helps homeowners if our economy starts to pick up, there's more jobs, and they can sell their Sydney house or have never been able to afford in Sydney and Melbourne, they can come over here and tap into that relative affordability. So you can see that we had a minor uptick back in the June 2017 quarter since. We've had a slight downtick again, and we really need this to break out and start coming back before we're actually in recovery mode. So at the moment, all of us are more calling it the bottom. So we haven't really reached round into strong start of a recovery yet. And the median price for units are trailing the housing market. They do this in all the capitals by about 12 to 18 months. So even when we get round to recovery in houses, expect units to take that much longer to get around. And you can see that that's been more of a sharp decrease, and we haven't even seen any major upticks in that yet, and I expect that to continue to adjust for a little while. And it's kind of leveled out a little bit, but it'll probably start to level out a bit more, but slightly decrease. On the rental side, and obviously as our rental market comes back and our rental yields improve, it starts to make it more attractive to investors, and that's what the eastern states investors are all really waiting on. They want to see our vacancy rate tighten up and our rental price start to recover, and that will be a good sign for them to start, they can see value, but they need to also see the other half of the equation, which is the rental side, start to come back too. And I'm excited that our number for rent has had some significant drops in the last 4 to 5 months, and we actually are now at, I think it's just over 8,500 properties for rent. We're up at 11,000 odd at one stage back in September of 16. So that's really going, the right way. 14% decrease since January, so it's tightening up, and 24% since last year. That's real tight, significant decrease since just a year ago. And the vacancy rate, as there's less properties for rent, the vacancy rate will tighten up too. And you can see that, drop from 7.6%, we're now at 5%. And I noted there that, I would love to have seen it stick within this new trend line, but it's kind of just drifting sideways a bit, which when I track back seasonally, winter is shocking for rentals. There's just so little tenancy changeover. We don't write our leases to expire then, we spread them out into the more active periods of the year, and there's less people looking to change over. So it's in part seasonal, but I really want to see this start, to continue to go down. Now with vacancy rate, 3% is the understood rule of thumb for a market where supply is meeting demand. And when we drop below 3%, that's when we see pressure on rental prices. So I wouldn't imagine our rental price, median rent, will start coming up until we see this get closer to the 3% mark in vacancy. What we're seeing on the individual property level and the individual suburb level, family homes in popular areas we're already getting rental increases on. Properties that are a bit more unique, we're seeing rental increases on. Unfortunately, the units are faring worse than houses, and it's similar on both the sale side and the rental side. So that's unchanged in the last year and the last 6 months at 350, and at least it's stabilised, thank God, because my revenue is directly proportionate to the rental price, and so is for all of my landlords, and it was a very, very painful 2 to 3 years of having a 25% drop in the revenue for all of us. So we've hung on, and we're actually starting to see marginal increases. I celebrate 30-cent increases in the average rent on our overall portfolio. And keeping in mind we manage in 200 suburbs of Perth, and so we really represent an average of the whole market. So this doesn't show a 30-cent increase in the average median, but at least our portfolio is. So the property clock, and I love keeping an eye on Darren Todd White's property clock because it's the main Bible that all the investors around Australia use, and to be honest, it's a self-fulfilling prophecy. When people see it as signalling recovery, then more investors jump in and makes it definitely a recovery. So we've even seen inquiry and more interest start now that we've gotten to the bottom of the market in the last, as of 2 months ago. And you can see where we relate to the other capitals. Sydney in a declining market now, and Brisbane up here. Where is it? There. In a rising market, and start of recovery. We've got the southeast Queensland areas and a few other Queensland mining areas, and southwest WA is faring a bit better off than the Perth region. So that's actually a bit further round than I've been, really trying to get my head behind why that started to recover first, because I haven't seen that happen before that way. And I think it was just relatively really good buying and had dropped further. And those that have been able to have had the money to go and buy a nice place down in the Busseltons, Bunburys have. And we were also seeing a lot of people decide to move down there permanently and, sell the family home or whatever, retire. There's retirees that have been holding off doing it, have decided I'm going to go a bit further than Mandurah, I'm going to put an extra 200,000 or 300,000 in my pocket and buy something really good, even better value further down, and that's kind of, I believe, what is behind, that starting to recover sooner. But it did drop further than the average suburb did in Perth. So unit market, you can see we're still labelled as a declining market back around here, and as I mentioned, that would be probably 12, 18 months before it gets around to its bottom of market phase. And so when you look at units, there's a number of different units that are all chucked together in one category. And it's not really fair to just paint them all with the same brush. There's high density complexes, which I would say this is definitely the case for. Then there's villas and townhouses, which are lesser density. And we're actually finding that they're going to be a lot more unique and sought after in the coming 5 to 10 years because they have a land component and they have often low or no strata fees. And people can actually have a little courtyard garden, and it's because they're all ground level, it suits the ageing population better than a multi-level walk-up high-density apartment does as well. So I am personally looking at units that fit those villa and townhouse categories if they might need a renovation. Some of them, built in the 80s and 90s, can be part of small groups and suitable for this strategy. Especially if you're looking at infill, closer locations, not Clarkson, Butler, stick within 10, 15 k's if you can. So the economic forecast, this comes out every 6 months by the Chamber of Commerce, and I love circling it in my calendar and getting it. And the exciting thing that these stats don't say is that the forecast is actually, we're actually tracking better than they forecasted a year ago, which is rare for statisticians. They must have been more pessimistic given the last 2 or 3 years and didn't expect us to start recovering this week, so that's good. And you can see just how shit our economy was coming off this. Look, I'll just point out a few of the key stats. Dwelling investment down 19% in 16-17 year, down 10% this year, and expected to be at 2 and 5%. That's one of the key categories that impacts the property market. Business investment, that all flows through to job creation ultimately, down 28% in that previous financial year, down 5% this year, and then forecasting 3 and 5%. So not massive, upticks in any of those categories compared to where we were at with the boom, but we should obviously see things starting to gradually recover with them swinging around into the positive. So I'm just predicting next 2-3 years where we need to be selective. It's a good period because we can actually count on the value being what the value is and not have to worry about it declining or going backwards. How can you do a project if you're planning on an end selling price and then you get there and the price is not there? So I'm in my business mind, I'm just like, as long as the price stays the same, I can work with that. I can plan towards that, and I can make selective moves, calculated moves to make money, and there's a lot of other benefits to being in this type of market, which we'll